In today's video, I'm going to show you some examples of the interest crediting methods, along with the methods used to calculate the gain on the market index for your fixed indexed annuity, so that you can get a better understanding of how those calculations actually work. Which method do you think will produce the most gain allocated to your fixed indexed annuity in any given period? Well, you'll have a better understanding of how those calculations work, and you may be able to figure out which one is more beneficial to you for your fixed indexed annuity in any given period. By the end of this video, I'll give you the facts so that you can make an informed decision about whether a fixed indexed annuity is the right fit for your retirement income planning needs. Hi, my name is Darlene Hartman. I'm a CPA and founder of D. Hartman Consulting, LLC. For the best retirement annuity advice, subscribe to my YouTube channel and hit that notification bell so that you can receive notices anytime I post a new video. Let's get started by looking at the calculations for the interest crediting methods. And just as a reminder, those interest crediting methods that we're going to look at are cap rates, participation rates, and then a combination of a participation rate with a spread or margin. As shown in this slide, I used the past 20 years annual returns for the S&P 500 and calculated the percentage gain allocated to a fixed indexed annuity based on a 3.5% cap rate, 30% participation rate, and a combination of 40% participation rate with a 4% margin. Now of note, the balance of your fixed indexed annuity at the end of each year is calculated based on your deposits into the contract, plus the amount of gain credited to your fixed indexed annuity, less any annual fees on your fixed indexed annuity due to the addition of features or income riders on your fixed indexed annuity. This is referred to as the accumulated value of annuity. In this example, I assumed no fees, and the inclusion of fees in this analysis could have a significant impact on the results. Based on this analysis, the participation rate looks like the best option between the three based on the annualized return, right? Well, actually, this analysis is based on historical returns of the S&P 500. And if I prepared an example with projected single-digit annual returns, the participation rate may not be the best option for your fixed indexed annuity. So what are the market returns going to be in the upcoming years so we can figure out which interest crediting method we want to choose for our fixed indexed annuity? Well, analysts are saying in 2021 to expect moderate growth in your equities. So not the type of growth that we've been experiencing in the past decade or so. Wait a minute. No one can predict the performance of the market. Let's look at 2020 alone. So the S&P ended over 18% after taking a pretty big hit in March of the same year. But I also want you to keep in mind that insurance companies can change the rates on the interest crediting methods on an annual basis. So don't get too comfortable with those rates that you see when you sign that contract, because each year it is at the discretion of the insurance company to make changes in those rates. And don't be tricked into believing that one interest crediting method is better than the other, because the performance from those interest crediting methods is based off of the performance of the market. And if no one can predict the performance of the market, then you're not going to know which interest crediting method works best for your fixed indexed annuity until the end of that reporting period. Leave me a comment in the section below and let me know which interest crediting method you would prefer for your fixed indexed annuity. Also, if you're enjoying this video, be sure to give me a thumbs up, subscribe to my YouTube channel, and hit that notification bell so that you can receive notices anytime I post a new video. Remember those monthly point-to-point and monthly averaging methods that I discussed in my video that talked about how gains are computed on a market index? Well, that's what we're going to talk about now, so let's get started. On this slide, I'm only demonstrating the calculation for 1 year. Wow, You would have an interest allocation of 18% in 2020 if month-to-month method was used. And yes, you're more likely to obtain a better return with this method than the methods discussed in the previous slides. But don't forget, there's no floor for monthly returns. So you can also be more likely to end up with a negative annual return and therefore nothing allocated to your fixed indexed annuity for the year, even if the annual return at the end of the year was positive. Worth the risk? Well, that's your call. As you can see, the monthly averaging method is the most conservative of all methods and is subjected to the interest crediting method, of which a cap rate of 3% was used in this example. Depending on the insurance carrier that you select for your fixed indexed annuity, you may actually have the option of several interest crediting methods within your fixed indexed annuity. You also may have the option of using several different market indexes, of which the S&P 500 is just one of those index choices. Now let's look at all of the methods on one slide for the year 2020. Don't forget, no costs were factored into this analysis. And this analysis is based on historical returns. And there is no way to predict future returns for tomorrow, much less next month, this year. You get the idea. And the insurance company can change rates used for the interest crediting methods at its discretion on an annual basis. If you are interested in obtaining a fixed indexed annuity for your retirement portfolio for the guaranteed income benefits that it can provide you, click the link below to apply to become my client. Also, if you enjoyed this video, be sure to give me a thumbs up, subscribe to my channel, and share it with your family and friends. Let's get the conversation started on how you can live your best retirement while not outliving your money.